Hi, Bill Bodnar here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, mortgage-backed securities, we'll start with the chart, on the right side, a couple of red candles, kind of finish up the week. But the big thing is that we're unable to take out those highs seen earlier this year, right? The high was, back on the Thursday, that first Thursday of the month was the high tick of the year in mortgage-backed securities. We're not able to even test that. And it's because it was associated with some really good news, right? We had a great jobs report then. And then on the second month, the second Friday of the month, same thing again, great jobs report, dovish Fed. So here we are again this week, dovish Fed. We had the Fed minutes come out on Wednesday. And that was a really important Fed minutes because we wanted to see confirmation that there was indeed a dovish tone to the Fed. And we did get that confirmation. In fact, it seems unanimous that the runoff of the balance sheet may stop at the end of the year. And remember, that balance sheet runoff, they have about $3.8 trillion worth of securities, mortgage-backed securities and treasuries. They're unwinding that big asset, and in doing so, it is like tightening. So they're talking about maybe laying off that. Well, why are they talking about laying off that? Number one, stock market started to struggle, and they came out beginning of the year and said, hey, markets, we're watching you, right? So that was one thing. So you could kind of read the tea leaves there. But the other big thing that they mentioned earlier this year, and we're getting confirmation all the time, is that things are starting to slow around the globe. We're seeing Germany, some of their numbers have been pretty bad. And so with their yields real low, right? I think now the German Bund is yielding about 12 basis points, where our 10-year note yield is yielding about 268. Big difference, right? And normally there's about 165 basis point spread between those instruments. That is blown up, and so they're struggling there. So the Fed is not in a position now to hike, and so that's what we're seeing right now because of the problems that are abroad. There's no inflation. But next week, we got to start looking at some of these things because what's going to happen is we're going to have the Fed come out on Wednesday with their monetary policy report to Congress. This is a big deal. They do it twice a year. And this is where they get in front of Congress and talk about where we are. And we're expecting that dovish tone to continue, and that they're watching the markets, and the inflation is in check. These are things that we're going to look for, but also during the week, we are going to get some numbers as it relates to inflation. We have PCE. This is the big one. This is next Friday, the 1st. So mark your calendars. That could be a big number. But right now, the Fed has said that they don't expect inflation to be an issue for the next few years. So the takeaway there is if inflation is not an issue and the Fed can't hike rates, they're in a tough spot right now for hiking rates. It's really difficult to see long-term rates like mortgages go up materially from here. And then when you couple, obviously, what's going on across the pond and yields abroad being depressed, it's tough to see yields go much higher. But at the same time, when you look at the chart, when you see ourselves at a one-year peak, if you have clients that are, thinking about, they can benefit from today's pricing in the next 30 to 40 days, boy, it would certainly make sense to lock here because we're at one-year rates, one-year lows in rates. Could things get a little bit better? Yes. And one thing I would say from a technical basis that I will leave you with is I like the way the moving averages here are starting to turn higher. Something we're going to watch for in the weeks ahead. If you notice, they were all bundled. The 25 and the 50 were beneath the 200-day moving average. Now those have started to turn higher. If the bond market can turn higher from here and take out these one-year highs, I think that it'll set up for the lowest rates in quite some time for this spring, which would be pretty welcome. Well, anyway, thank you for tuning in. Have yourself a great weekend. We'll talk to you soon. Bye now.